The U.S. housing market continues to be a focal point for investors and homeowners alike. With mortgage rates and affordability under pressure, the dynamics of supply, demand, and pricing are shifting across the country. So, where do mortgage rates and home prices go from here? We're going to break it all down for you right now on UBS Trending. Hi, everyone, and thank you so much for joining me. I'm Anthony Pastore here in our studios in New York City, and this is UBS Trending. Andy Walden, the head of mortgage and housing market research at ICE, is my guest for today's discussion. Andy, welcome to the show. I'm really looking forward to our conversation, and I think we talked about this before you even sat down with me today, that we do a regular survey here at UBS to many of our clients, and usually in the top 5, sometimes the top 2 or 3, housing and housing rates and refinancing rates are a huge topic of interest and discussion. So great timing for you to join me. Thanks for coming through.
I appreciate you having me. Excited to talk about it.
Of course. So, I want to go back to, what I was saying in the introduction is talking about the housing market from supply, demand, obviously price. There's been a lot of conversation over the last year about affordability. We know that mortgage rates have come down, but were significantly higher just a few months ago. So what are you seeing in some of the various geographies across the U.S. and, what's the temperature out there right now for housing?
Yeah, we're seeing some noticeable shifts late this year, right? So if you look at just the supply side itself, the storyline for the last 2.5 years has been this gradual improvement in terms of the number of homes available for sale. That continued into the summer months this year, and then housing really softened up when we got to that 15% deficit range, and sellers started to pull out of the market a little bit. And so we're dealing with this inflection point in the market where supply is better than it has been in recent years. But some of those West Coast and some of those southern markets that have been struggling from a price perspective have started to see the number of homes available for sale pull back as delistings occur and as homes are listed at a little bit lower rate. On the demand side of the house, things are looking a little bit better, right? Interest rates, as you mentioned, have eased a little bit. Affordability has improved. We've hit 9 of our 10 best weeks in the last 3 years from a demand perspective since rates have come down in September. So some improvement there. And then when you put both of those together, a little bit less supply, a little bit more demand, we're seeing a little bit firmer home price dynamics here in October. Fewer markets where prices are easing, a little bit more firmness. We're still running at roughly a 1% growth rate nationally, which is, as you know, pretty low from a historical perspective, but starting to firm up a little bit. Very clear differentiation in the market from a geographic perspective. Midwest, Northeast continue to broadly see home prices go up as high as 7 to 9% year-over-year home price growth rates when you get into Connecticut and New York and some of those northeastern markets. And then the exact opposite when you get into the south and western regions of the country. You've got the Gulf Coast of Florida that's down 7 to 9% from the same time last year. So a lot of different dynamics when you look from a supply side and in a price dynamic standpoint at different points across the country.
Yeah, and it's interesting, when you talk about the geographic areas, I actually just read a report. I live in New York City, and house prices and apartment prices here are certainly going up, as you mentioned. But then you have areas of the country. Florida has been hit by storms. Insurance is really tough to get there in a lot of neighborhoods. I wonder is that something that you see as part of why there's maybe less supply, or the prices are maybe coming down a little bit?
Yeah, I mean, absolutely. You look at the 2 areas that are seeing the softest home price growth. They're actually the largest home price declines year over year. They're the areas that were hit by 2 major hurricanes last year, right? So you've got some reconstruction taking place in those particular areas. You've got rising property insurance costs in those particular areas as well. And really, when you look at price, it's a supply side story. Anywhere that has supply returning back to or above pre-pandemic levels, you're largely seeing prices leveling off or coming down in areas like New York City that you mentioned. And really, this is a storyline across the Northeast in areas where you just have not seen that supply return. You're at a 40, 50, 60% deficit of where you should be. Prices are continuing to push higher. So a lot of the price dynamics are simply driven by how many homes there are for sale in markets across the country.
Andy, are we seeing any growth in sort of the negative equity rates that the market should be aware of? Because that really does play into the affordability topic a lot.
Yeah. When you look across the country as a whole, roughly a third of major markets are off their recent peaks. 1 in 10 are off their peaks by 5% or more. Obviously, when you start to see prices come down a little bit, negative equity becomes a bigger storyline. When we look at it from a national perspective, we're seeing a return to normal. So negative equity rates are up a little bit, but still pretty low from a historical perspective. 1.6% of all homes, about 900,000, are underwater nationwide. So nationally, not an overly concerning stat or data point or storyline. But as you mentioned, there are some specific geographies where this is a more meaningful topic of conversation, right? A couple that I would call out. Austin, Texas has seen home prices fall by 21% from where they peaked out in 2022. 7% of homeowners in Austin are now underwater, primarily folks that bought in recent years using lower down payment mortgages. We talked about the Gulf Coast of Florida a little bit ago, right? Prices now down 15% from their recent peaks. 7 to 11% of properties, depending on the market that you look at in the Gulf area down there, are underwater on their mortgages now. So nationally, not overly concerning. There are a lot of areas across the country where it's almost obsolete that folks are in a negative equity position. But there are certain pockets of the country that if you start to see some financial stresses and homeowners start to struggle making their mortgage payments, now that becomes an issue. Right now, we're talking about, are these homeowners in need of short sales? Do we see an increase in foreclosure and REO sale activity and distressed home sales that could further compound those home price constraints?
Excellent. Thanks, Andy. Yeah, right now we're looking at the 30-year rate being about 6.3%. It was upwards of 8.5% at its peak. So, and one of the interesting statistics that I see a lot is that something like 1 in 5 U.S. homeowners have a rate that is under 6%. I think there's a lot more under 4% because many people who own their homes for a few years refinanced back when the rates were really low in 2016, 17. So, it's not like there's a huge cohort out there who are trying to buy homes at these, 6.3 or higher percent rates. It's such an interesting market that we're looking at here these days.
Yeah, it absolutely is, right? And it's really this bifurcated market where if you bought or took out your mortgage before 2022, you look at and see the world in a very different light than folks that bought in 2022 or later at higher interest rates, or even folks trying to get into the market today. So you're seeing very different dynamics and just a different mindset depending on when you got into this market. Were you able to lock in one of those record low interest rates? Or are you trying to get into the market today at kind of these mid 6% rates?
So I'm one of the people who took out a home equity line of credit for a big renovation I did in my home, and I used part of that as a HELOC. And of course, I did it 3 years ago, just when rates were about to peak. And so I'm glad to see them starting to come down. But when you look at the home equity side of the market, because a lot of people who are staying in their homes because they have these really low 30-year rates or 15-year rates are thinking, well, if I'm going to stay, I want to do some renovations, and they're taking out these home equity loans. What does that look like? And does the Fed lowering rates, as we expect them to do, how much of an impact is that going to have long term on the ability for people to kind of take out these HELOCs or home equity, at slightly lower rates? Because a lot of them are variable. You're not getting a fixed rate on most of those loans. That's another question I know that comes up a lot from our clients.
Yeah, I think it has a huge impact, right? If we start with just how much equity is there to borrow against, right? If you look at the average mortgaged home in the U.S., it's about 46% debt, about 54% equity. That's a pretty strong equity standpoint that most homeowners are sitting in right now. If you look at the total amount of equity out there to borrow against, you've got about $11.2 trillion of equity total that could be withdrawn while still keeping a pretty safe 20% equity cushion in your home. It's about $200,000 per homeowner. So a lot of those folks in the same position that you are looking at, I have this big asset sitting on the sidelines. I haven't been able to tap into it due to higher interest rates. What does that look like now, and what could that look like? And you brought up the Fed. I think that's a very important piece of this conversation because, to your point, if we looked at this at the beginning of 2024, before the Fed started to cut interest rates, the average interest rate offering on a home equity line of credit was 10%. It's about 7 to 7.5% now. So we've already seen that come down by 2.5 percentage points. It's cut the monthly payment required to withdraw equity by 25% already. And then if you look at the potential for the Fed to cut 3 additional times through the tail end of next year, that could cut that cost or that monthly payment requirement by another 15 to 20%. So instead of a $400 monthly payment to tap into $50,000 in equity, by the end of next year, you could be looking at closer to a $250 monthly payment to tap into equity. That could attract a lot of homeowners like yourself that are looking to do renovations, but also folks looking to consolidate some of that debt that they've accrued in recent years as well. So homeowners certainly looking at this as a potential opportunity for them to tap into that equity at a lower cost. lenders out there in the market looking at that potential increase in demand as some potential opportunity for lending over the next couple of years as well.
Before I let you go, Andy, I do want to talk about refinancing because that's another segment of this market. And we have a chart that you sent us that we'll pull up here in a second talking about application volumes. Clearly, there was a huge spike in refinancing in around the 2020 area when rates were super low. So most people are locked in at a rate they like. There are still out there who maybe bought their home in the last 2 years when rates are high. What does the refinancing market look like right now for those that might be at 6.5% or above on their current mortgage rate?
Sure. And I mean, we're nowhere near where we were 2020, 21. That was in a completely different world, right? Even from what we had seen prior to that. So we're not looking at anything near those volumes. But what you are seeing is a meaningful number of homeowners that have purchased a home over the last 2.5 years at a high 6% or 7% interest rate that are really looking for that window of opportunity to go out there and drop that interest rate. And the low 6% band is a really interesting environment for mortgage rates. It's very sensitive, right? And the reason behind that is nobody wanted a 7% interest rate in recent years. Even when rates were in the 7s or 8% range, a lot of folks were buying down those interest rates to have a 6 in the front. So the largest distribution of homeowners that have bought in recent years have a 6.875, 6.95, 6.99% interest rate. If you look at the traditional 75 basis point requirement or incentive threshold to incentivize folks to jump in and refinance, that means that 6.25, 6 1/8, 6% are very sensitive points for the market in terms of refinance incentive and refinance opportunity. We got a good taste of that over the last couple of months, right? Refinance applications hit a 3-year high here in September. They were up 40% from September last year, even though rates were a little bit lower last year. October saw twice as many refi apps as we saw last year. So, as we get into that low 6% range, some of those borrowers start to jump out of the woodwork and start to jump in there to refinance. And if you look at futures pricing and where that's putting interest rates over the next 6 months, it says, the market's pricing in mortgage rates to come down maybe 1/8% through, the early stages of 2026 could move us into those thresholds where you see more of that refinance opportunity and incentive for folks to kind of jump in and get out of some of those rates that they bought at in recent years.
Excellent. Andy, thanks very much. There is some encouragement there for those folks who did buy their homes and get their mortgages in the last year or two. So thanks for bringing us through. Great topic, Andy. I really appreciate you jumping on with us today.
You bet. Appreciate you having me.
Absolutely. We'll see you soon. Andy Walden, again, head of mortgage and housing market research at ICE. And for more information on anything we spoke about today, please visit our Insights website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook, as well as Instagram. You can check out our dedicated channel at UBS Trending. Lots of great content there for you. And if you have any questions about what Andy and I spoke about today, make sure that you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.